The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. My name is Scott Kessler, Director of Equity Research with CFRA. Welcome to today's webinar, The Payments Revolution, Winners and Losers as the World Goes Digital. During today's session, my colleagues and I will discuss the payments landscape, related companies and stocks, and our views about possible winners and losers. But before we get started, I wanted to make sure you know that today's session is being recorded, and a link to the replay will be made available soon. During our webinar, you can submit questions using the GoToWebinar questions panel, and we will try to answer as many of them as we can. Let's move to introductions. Before we dive in, here are some details about our panelists. Chris Kuiper is an equity analyst at CFRA who covers the consumer finance area as well as the market exchange and REIT areas. Before joining CFRA, Chris worked as an analyst for a large cap value fund, a fundamental analyst for Calamos Investments, and a credit analyst for TCF Bank. David Holt also is an equity analyst at CFRA, responsible for technology sector coverage with a focus on IT services, including payments-related areas. David held a similar position at S&P Global Market Intelligence. Previously, David was an analyst at RBC Capital Markets and Charter Equity Research. I'm doing double duty today as a panelist and your moderator, as I have covered a number of payments-focused companies over the years I've spent at CFRA and S&P Global. So here's today's agenda. I think it's pretty self-explanatory. Chris is going to kick things off from a subject matter perspective, talking about the landscape for U.S. consumer finance companies. Then I'm going to talk about payments networks and the next payments giants. And then David is going to discuss payment processing and the value proposition these companies create behind the scenes, and then we'll move to Q&A. So I wanted to talk a little bit about CFRA. Obviously, you know who we are. You probably know that CFRA bought S&P Global's equity and fund research business in 2016. Seems like, and really was, a pretty long time ago. This slide really depicts one very obvious reality for us, and that is that we're committed to providing our clients and end users with global, independent, and actionable research to help them make better investment and business decisions. I don't think a lot of people realize that CFRA has many large and important clients across many categories of not only financial services, but also other areas as well. And you can see us indicating that we work with not just areas across financial services, but private companies, accounting firms, insurance companies, and law firms as well. Let's go to the next slide. The last thing I'll say about CFRA before we move into the subject matter portion of the presentation is that I think it's really important that people know and understand that we have really expansive equity research coverage that's made possible by a large and talented team of analysts around the world. There are a lot of numbers here. I'd point to our analysts covering more than 1,500 companies on a qualitative basis. In addition, we cover all 11 sectors and 68 industries, and we also have very differentiated and significant ETF and mutual fund coverage as well. So with that, let me pass things along to Chris Kuiper, who's going to talk about the landscape for U.S. consumer finance companies pertaining specifically to payments. Chris?
Thanks, Scott. So as Scott mentioned, I cover the consumer finance industry, which is largely what you'd think of as what is known as the pure play credit card companies. But first of all, I just wanted to kind of orient ourselves as we go through this to the landscape and the size of the industry. So first of all, just to get a grasp on the size of the industry, in short, the global payments industry is massive and still growing. Global payment revenue grew 11% in 2017, which was a pretty sharp increase. We're now into that double-digit realm, to $1.9 trillion. It's expected to grow 7% in the next 5 years, so moderating slightly, but that's still going to be a $2 trillion market by 2020 and $3 trillion within 5 years. A lot of this growth has been fueled by the Asia Pacific region, which grew 12% last year, but North America still grew at a 5% rate, and that's actually expected to go up to 7% in the next 5 years on a compound annual growth rate basis. The big drivers of this growth, the big one is declining use of cash. It might be surprising, but the share of the world transactions in cash is still at 77%. So this is a huge opportunity, but that's down from 89% over the past 5 years. And I think we're going to see that rate accelerate, not just go on a linear decline. Another one is the personal consumption expenditure level, which my colleague David Holt is going to talk about more later. And then the increase in e-commerce. We want to highlight this. If you look at the next slide, e-commerce sales are growing nearly 3 times as fast as total retail sales, so 15% versus 5%. And e-commerce is still only about 10 to 11% of total retail sales. So we project a long runway for e-commerce growth, and that uses electronic payments almost exclusively. Now, obviously, it's not a one-to-one delta. You know, there are some people that are shopping in brick-and-mortar stores that are already using credit cards or electronic payments. But the fact that e-commerce is so focused on electronic payments means this is still going to get a very big boost. So if we go to the next slide, here's how you can kind of see the lay of the land or a map of how this actually works, which is surprising to some people. When I first started covering this industry, I was surprised by a number of things here. This is what's known as an open loop or 4-party system. The 4 parties are the 4 corners of the square here. So you have the customer or the card holder. They're going to buy goods from a merchant. And if they use something like a credit card, you're going to have to have a card issuing bank, which is going to extend the credit and handle all the accounting. The merchant acquirer sits in between there. And then the service that passes all this information between the parties is usually the card network. So in this example, we have a 3% merchant discount rate, as it's known. This is the total fee that the merchant is going to pay to accept a credit card. So if someone buys $100 of goods, they're only going to receive $97 back. And in the blue text, you can see how that fee is kind of divvied up. A lot of people see a network like Visa or Mastercard, and they think they're the ones getting all this money. But it's actually 60 to 70% of the fee going to the card issuing bank, receiving it in the form of what's known as an interchange fee. So that just gets passed directly onto them. And then the merchant acquirer will keep the remaining fee before they submit it back to the merchant itself after the credit card network has taken a small cut. Now, if we go to the next slide, you'll see a little different system, what's known as a closed loop or 3-party system. So here you still have the customer buying something from the merchant, but all in between there, it's just one company, such as American Express, which I'll talk about. They receive the entire discount revenue, so there's no interchange fee. They're both the issuing bank. They also build and maintain the network, and then they can even also be the merchant acquirer and interface directly with the merchant. So looking at the economics of these in the next slide, the way they're set up, you get some different incentives. So in an open loop system, networks like Visa and Mastercard, they're going to look to partner with the banks. They want to be that preferred network. They're going to emphasize growing that network and the number of transactions on that network. Whereas in a closed loop, they would also like these things, but the emphasis is going to be actually a little different. They're going to handle every step. There's no interchange fee. And so they would really like to see the current cardholders spend more. And the reason for this is you're just going to get a lot more leverage to your revenue. There's a higher delta there because if you think of it as a percentage, they're getting a fee as a percentage of the entire transaction, say 3%. The more those cardholders spend, the more leverage they get to the revenue growth. They also control the entire process. So they have insight from start to finish in terms of data. And that puts them in a unique position, which I'll talk a little bit about later as well. And then the other unique thing about a closed loop system is if they're also the issuing bank, they're going to be taking on the credit risk. the card networks like Visa and Mastercard don't have to worry about this. They just have to worry about keeping their network up and running. But someone like an American Express, they're going to have some credit risk. But on the flip side, they also get the benefit of receiving interest, so they have net interest income. And then they can also get things like late fees or card membership fees. So specifically looking at American Express on the next slide here, with their closed loop system, they term their business model as very spend-centric. And this is one of the things that prompted us to originally upgrade the stock in Q1 of 2018. They far surpassed their peers in the amount of spending. And we think that was really driven by or helped by American Express's high net worth clientele. They have some of the highest FICO score clients, and average spending on these cards can easily be $10,000 to $20,000 a year or more, especially when you consider a lot of small businesses use them as well. Another thing we like about American Express is their operating leverage. They've continually reduced their expenses year after year, little by little, and squeezing out a little more operating leverage on each step of the way. Unfortunately, the thing that's been working against them while they're doing good work with the nuts and bolts, they've had to increase their reward and marketing expense. If we go to the next slide, you can see that top line there is the rewards expense as a percentage of revenue. So it was less than 20% in 2013, now we're up to 24%. And then they actually break out services separately, but you could kind of consider this as part of the same expense. That's gone from 2.3 to 4.3%. And services are things like airport lounge access. So a lot of other companies lump those together, but you can see how both of these things are increasing. So that brings us to the next slide, where technology is certainly helping these companies provide a lot of value and differentiate themselves with rewards, but it's also creating what we know as a rewards war or a rewards arms race. So with technology, companies are adding, it seems like, a new feature or rewards every day or every week to a different card. You know, the classic ones are cashback, travel, hotels, airlines, expense reimbursements, even rideshare credits are a thing, like Uber credits, airport lounge access. But as they layer all of these rewards onto their cards, it gets very complicated, especially as they start offering the ability to transfer these points to partners, whether they're other airlines or other reward programs. And it's really spurned a whole cottage industry of travel hacking. Travel hackers also use technology to easily transfer points, track their spending, stay up on the latest sign-on bonuses, and they'll gather in blogs and forums and share tips on how to exploit these loopholes or inefficiencies. And to be clear, this is all perfectly legal. They're just taking advantage of the current system and incentives that they see there. So the big trend now that we've seen is credit cards are starting to scale back on rewards. I think the most prominent example would be Chase with their Sapphire card. They made a huge splash when they came out offering 100,000 bonus points for signing up. This was, their top tier card has a $400 or $500 annual fee. But even with that, people love the card so much they ran out of the metal cards that they used. They're actually metal instead of plastic, and the manufacturer got backed up and ran out. They've now scaled that back to only half, so 50,000 points to sign up. Chase quickly realized that it took 2 to 3 years for them to break even or start making money off of these accounts. And a lot of these savvy travel hackers would only keep the card for 1 or 2 years and then cancel it. So while we think that reward expense is going to moderate, we don't think it's going to go down, though, because this is still a very, very competitive industry. Moving to the next slide, just looking at the opportunities and threats that technology brings. A big one is e-wallets, whether we think they're friend or foe. These are things like your Apple Pay or your Google Pay. For now, we think they're a friend because they're operating just as like a pass-through wallet. So I still load my Visa, Mastercard, or American Express card into my Apple Pay wallet. And then when I swipe it over the Apple Pay, it still goes through all of those cards' networks and they still get the fee. So in the short term, this is going to give wider usage and more convenience to cardholders. So they're going to be using those cards more. So we think this is a positive for them. However, in the long term, we could see an erosion of brand. And the reason I say this is because if I put my American Express card into my Apple Pay wallet, I'm going to be, and I want to use my Apple Pay wallet because it's convenient, I'm going to be looking for the Apple Pay logo. and I'm going to swipe it over there, and the transaction is going to happen. And after time, I might even forget which card I loaded in there. And the reason this is important is because for these companies, their brand is consistently one of their most valuable assets. It's an intangible asset for sure, but this is why they spend such enormous amounts of money in marketing, logo promotion, ads, placement, Super Bowl ads, all those kinds of things. Is because they know consumers need to pull out that Mastercard, recognize that brand, recognize that logo in a store. But if they're constantly using their e-wallets, that might erode that over time. A second opportunity we see, which I mentioned before, was the closed loop system. So because a closed loop provider like American Express can see every step of the transaction, they have insight into all the data. They are using this data, but it's mostly on the back end. So they're using it for things like identifying fraud or underwriting credit risk. But we'd like to see them leverage it more on the front end. So perhaps targeting specific consumers or partnering with merchants to try to help them target consumers more effectively. But that just hasn't really been done yet. So we see this as an untapped potential. They've paid lip service to it, but we haven't seen anything really definitive yet. And then finally, you can't talk about payment technology without talking about blockchain. When blockchain and Bitcoin came out, of course, everyone said this was going to completely upend the industry. They were going to cut these fat 3% fees down to nothing because it's completely decentralized and you don't need to go through the banks and you don't need to pay the big interchange fee. However, that's been a little more hype. And in the near term, we actually see blockchain technology helping these companies. And it's going to help them because it's going to drive down costs. So probably one of the best examples is American Express has partnered with and is even starting to use Ripple a little bit. Ripple is technology built on the blockchain technology, and they make it easier and cheaper to send money across borders. Usually it's very expensive to send money across borders. American Express is a global company, has to do this all the time. So if they can harness this technology, they can greatly cut those expenses there. In the long term, it could be a potential disruptor, but we think these companies will be looking to partner and use the technology. And then finally, I'll close with where we stand with the pure play credit card companies. These are the primary companies I cover. American Express, as I've alluded to, has a very valuable brand name. They dominate the high net worth, high spend cardholder segment. We think they could use their closed network more, but overall, we still remain positive and they remain a buy rating at this time. Discover Financial, they're also closed looped. One of their advantage of being smaller is that they're not regulated like a large bank like American Express is. But because they're smaller, they also have no global presence. So in the domestic market, it's going to be very hard for them to take wallet share. They're not as big. They can't offer quite as good rewards. And they've always kind of been a tier 2 or a B player throughout the industry. Capital One, to be clear, we really like Capital One's business. We think they're running it well. They have a very technology-focused culture. They like to think of themselves as a technology company first and a financial company second, which we are sympathetic to. You know, their headquarters are right in my backyard here in Virginia, and I know a number of people that work there, all in tech or development or data science, and I definitely think that culture is there. But that's not going to make them immune to the industry that they're still in. So we did downgrade Capital One to a sell rating from a hold this past Thursday, just because we see some near-term exposure due to the extended credit cycle. Capital One has one of the highest exposures to the subprime credit card market, a little over 30%. And then they also have a chunk of their business tied to auto loans. And with interest rates rising and auto sales at record highs, we think there could be a risk that that starts to slow down. That's not quite priced in yet. And then Synchrony Financial, we downgraded them early on in 2018 as we thought investors were underappreciating credit risk and slowing loan growth. In the interim, they actually lost Walmart, one of their major customers, to Capital One. And interestingly, Walmart specifically cited they wanted to partner with Capital One to help their mobile payments. So they saw Capital One as a better technology partner there. We still think investors are underappreciating credit risk and slowing loan growth, and they're overestimating Synchrony's ability to replace that lost Walmart revenue. If you look back at American Express, one of the more recent ones when they lost Costco, it took them a very long time to not only regain that revenue, but also just kind of regain the market's trusts there as well. So that's where we stand with the pure play credit card companies. I'll hand it back over to Scott to talk about networks.
Great, thanks a lot, Chris. So let's go to slide 20. So this is kind of a table setter slide. The blue bars represent the size of 2017 payment volumes for various transaction types, and the percentages in the ovals indicate the growth or decline that year. What I think is the most noteworthy about this slide is the continuing growth in credit cards in particular, accounting for a 10% increase in 2017, and the continuing decline in checks with a 17% drop in 2017. What this chart really shows is that consumer payments continue to shift notably to digital payments and away from paper payments. And you can see cash, still a lot of people are transacting in cash, but the growth in cash transactions is the lowest of any of the categories depicted here, save checks, which has obviously been declining. Let's go to the next slide. So card networks. Chris talked a little bit about the notion of card networks, and I wanted to put not just a finer point, but maybe a different point on what they are. So credit card networks control where credit cards can be accepted and make possible transactions between merchants and card issuers. And we'll get to card issuers in a couple of slides. There are, as Chris alluded to some extent, there are 4 major credit card networks: Visa, Mastercard, American Express, and Discover. The chart, the pie chart on the right, shows dollar volume market share among these 4 big global players. And what is obvious, I think, is not only is Visa dominant, accounting for almost 2/3 of this market, but Mastercard accounts for almost 1/3 of the market. So the two companies combined obviously constitute an overwhelming majority, almost a duopoly when it comes to this particular category, with American Express and Discover. Discover is that red sliver accounting for the balance. I think that's probably representative of the notion that Chris was talking about, which is open versus closed network. Let's go to the next slide. So I wanted to provide some additional context around the size of this market. $17.5 trillion is the amount of payment volume that Visa, MasterCard, American Express, and Discover generated over their most recently completed annual periods. I think 17.5 trillion is such a big number, it's really difficult to kind of appreciate. It's only slightly below our GDP for the US in 2017 of 19.4 trillion, and that 17.5 trillion, it translates to over $33 billion per minute in transactions. So really what I want to try to communicate with this slide is the fact that it's just a massive market, and these two players, in particular Visa and MasterCard, do have very significant share. So let's go to slide 23. So I wanted to get back to the difference between, or the differences between card networks and card issuers. The issuer is the bank that backs the credit card. Issuers, they receive applications and make related decisions. They set account terms and most benefits. Chris obviously was talking about the Chase Sapphire Reserve credit card. Clearly, most of those benefits were provided by the issuer, in that case, JP Morgan Chase. But in some cases, you do have the network companies responsible for benefits, but they really pale in comparison generally to what the issuers are responsible for. Not only are the issuers responsible for decisions related to applications and account terms and benefits, but they collect payments. And I think pretty notably and probably obvious to most of us is they provide related customer service. And so you'll notice that the card networks are really mostly responsible for their networks, while the card issuers handle a lot of the daily issues related to the cards themselves. This is one of the reasons why the network companies have higher margins than the issuers. American Express and Discover, by the way, as Chris alluded to, are really uniquely positioned as both owners and operators of card networks as well as card issuers. It's why their networks are smaller. Go back to that pie chart. You're talking about 7% of the overall market for American Express and Discover. But those networks are very valuable to some extent because of the proprietary control and data that American Express and Discover have, and they can leverage that in a variety of ways. Let's go to slide 24. I wanted to take a closer look at Visa and Mastercard given their size and business models. If you look at Visa, growth has really been driven by its proprietary offerings and network as well as cross-border transactions. And cross-border transactions are basically when you have two, let's call it people or entities in or from different countries. So let's say I'm making a purchase from an entity that might be in the UK, or let's say that I'm engaging in a transaction when I am abroad. And so there are different aspects to cross-border transactions, but that's been a major growth driver for Visa and also actually for Mastercard. If you look also at Mastercard more specifically, growth has been driven by rising domestic as well as cross-border volumes. And I think it's fair to say that not only have these companies experienced notable growth, but they've been investing for growth as well. If you look at the categories, I'd kind of put them in two major buckets. One, providing different and maybe easier ways to make and take payments. One of the things I allude to regarding Visa is their tap to pay or contactless payments. If you were watching NFL football over the weekend, you probably saw an ad with Drew Brees for this very offering, tap to pay. But in addition to that, it's also about security. I think these companies are very mindful of security vulnerabilities and risks. And so both of these companies have been making pretty substantial investments in all different types of security to make sure that people and merchants have confidence in transactions. Let's go to the next slide. So these companies have a lot in common. I think people probably know that. They were both founded really from the late 1950s into the mid 1960s by California banks. They were both spun off and then renamed in the 1970s. They both have strong global brands, and I'm not sure people appreciate how strong they are. If you look at a recent report from Forbes released, I think in the spring of 2018, for all the world's brands, Visa ranked number 27 alongside Budweiser and Pepsi, and Mastercard was number 49 alongside UPS and JP Morgan. I think what also was interesting is that both ranked in the top 4 for financial services, with Visa being number 1, American Express, which Chris talked about, number 2, Wells Fargo at number 3. I wonder if that's going to decline a little bit, just given the continuing scandals at and around the company. And then number 4 is Mastercard. Both of these companies, by the way, are classified in the technology sector. I think a lot of people understandably think of these companies as financials companies, but that's just not the case. I remember being at S&P Global, and I think it was probably the better part of 2 decades ago, where S&P Global, it was really S&P Dow Jones Indices now, and MSCI, they made the decision that these companies were better classified in the technology area. And if you look at the S&P 500 technology sector, Visa was recently the third largest and Mastercard the fifth largest company based on their market capitalizations. The other point I wanted to make is I think it's interesting, they're technology companies and they're investing a lot in their networks and other technologies, but they don't report R&D within their income statements. And frankly, I think R&D and continuing innovation is critical to these companies in terms of their future growth. So let's go to the next slide. And you'll see what these companies have been doing in terms of growth investments. You know, they've both been very active in making acquisitions and investments. Visa acquired Visa Europe in 2016. The deal was valued at $21 billion, a huge deal that the company just completed the integration of in fiscal year 18, ended in September. Over the last couple of years, Visa has made 14 investments and acquisitions, and Mastercard really hasn't done anything close to as large as Visa Europe, but has made 11 investments and acquisitions over the same period. Why have these companies become so active in making investments and acquisitions? I think it's really competition, current competition and potential competition from the likes of fintech giants and leaders, and I would point to PayPal and Square specifically. So let's go to the next slide, slide 27. You know, in terms of context, I think it's noteworthy that these are newer companies. They were founded within the last couple of decades, and they both became public companies as currently constituted in 2015. Note that PayPal went public in 2002, and it was acquired by eBay, and then it was spun off by eBay in 2015. Both of these companies have multiple brands and businesses. PayPal has, you know, its namesake brand and business, but it also has Venmo and Braintree. Braintree focuses on merchants. Square, it has obviously its namesake business and brand, but it also has the Cash App and Caviar, which is around restaurant delivery. These companies have achieved pretty substantial scale across key metrics and pretty substantial size in terms of market cap. You know, go to the next slide. We'll talk a little bit about PayPal. We really think of PayPal as the first digital-only payments platform at scale. I think most people think of PayPal as the company behind the world's most powerful digital wallet offering. Chris alluded to this when he was talking about kind of the value of some of the network companies if they reside within these digital wallets. But I think PayPal's wallet really creates a tremendous amount of value. It bolsters trust for merchants, especially ones that you're not familiar with or you haven't heard of. And it allows for greater ease of use, speed, and security for consumers. You don't have to, you know, sit in a car trying to make a transaction and pulling out your wallet and inputting it into a mobile phone. It's all right there. PayPal is really focused on partnerships over the last couple of years. In fact, over the last 3 years, they've averaged a major new partnership every single month. And frankly, a lot of those partnerships have been with the companies that we've been talking about. We've been talking about card network companies, card issuers, and then, frankly, a lot of kind of internet companies that enable audience kind of aggregation and communication. PayPal really leverages many businesses and brands across multiple categories and consumers. And I think it's worth pointing to Venmo, where there's, you know, considerable monetization potential given the size and growth there. But we see at this point PayPal as a freestanding payment option that hasn't gained traction, right? I mean, as Chris mentioned and I just highlighted, when you use PayPal, you generally use it in the context of credit cards that you have. On the other hand, however, we think that the card network companies' efforts around digital wallets haven't gained traction. So this is kind of a successful marriage of convenience, if you will. And then let's go on to talk a little bit more about Square, slide 29. We really think of Square as about making money easier for merchants. Ordering an installation is really easy, and Square's offerings replace those of multiple other companies, so there aren't any compatibility issues or holdups. Merchants also gain access to valuable purchase data and analytics. If you think about expansion, there's been a lot of organic growth, just gaining share. But the company also has been expanding into new geographies and with new offerings, and we'd point to different hardware solutions. I highlight Register there, which is just an expansion of the point of sale offering based on a tablet that I think we're largely familiar with. But also, they've been getting involved in business loans and payroll services for merchants and a restaurant offering, and I mentioned Caviar, but that they have something customized for restaurants that I think is really interesting. Like we see for Venmo, we see potential for the Cash App. If you think about Square, though, they've been moving upstream to larger merchants. And while this has provided them with more and more share, we think it presents some challenges in terms of pricing pressure and margin pressure. When you're dealing with larger merchants, you have to think about things like not just pricing, but also more customer service. I'd also point out PayPal last year bought Square competitor iZettle. We've also noted the point of sale strength, but have questions about e-commerce, and would note that last week actually Square announced in-app purchasing options for merchants. We don't really feel too optimistically about that solution. And then the last two charts or slides really feature charts. Let's go to slide 30. This is really just the stock performance of Visa, MasterCard, American Express, and Discover. Over the last 5 years, Visa and MasterCard outperformed, and they outperformed, pretty strongly as compared to the other companies. But if you go to the next slide, what you see is Visa, MasterCard, PayPal, and Square, and PayPal and Square have notably outperformed. Obviously, you see the substantial decline in Square as the markets collapsed in the fourth quarter of last year, but still pretty substantial outperformance by Square, and PayPal was an outperformer as well. So with that, let me pass things along to David Holt to talk about the back office solutions and the value created behind the scenes. David.
Hey, thanks, Scott. Hello, all. Really excited to talk payments with you. You've already heard from Chris Kuiper, who kind of set the tone with a great summary and overall backdrop of payments, and Scott with some of the ins and outs of networks. But here we're really honing in on some of the names that operate behind the scenes. So while a lot of these companies might not be easily distinguishable by names or logos, they still play a large role in the payment ecosystem. So first up here on slide 33, just a quick refresher on the fundamentals of really how a payment's executed on the top diagram here. So here I really want to strictly focus on the processors in the middle of the top graphic. This flows down to the bottom chart, which takes more of a detailed snapshot into the actual payment value chain. So I've circled the two key roles I'm going to cover, which are merchant acquirers or front-end processors. Those are the names like WorldPay and First Data. These are the guys and gals that really authorize and settle payments to merchant banks. And the second one would be issuers. So these are back-end processors. Those include the likes of Fiserv and Fidelity Nationals of the world that really accept the settlement from front-end processors and move money from bank to bank. So moving along here to slide 34, we'll dig into some of the fundamental or foundational aspects that really drive the addressable market from a macro perspective. So personal consumption expenditures, or PCE, it really gauges more so the pulse of how much consumers are spending on either goods or services. So from a high-level perspective on the left-hand chart, PCE accounts for roughly around half or more of total economic output, or GDP. Of that total PCE, around 75% is actually up for grabs for incremental payment opportunities. So sliding over here to the right chart, which is a closer look at PCE, in 2017, this equated to around 12.5 trillion, or just a tad under 9.5 trillion, when you're actually applying that 75% capture rate in total opportunity. So recently, total PCE growth is bumped along at around 4 to 4.5%. But a lot of these companies have been able to outgrow some of these macro trends by either share gains or secular growth channels, which we'll dive into in more detail in the next couple of slides. So, okay, now on slide 34 here, I know this looks a little dense, but really I'm just trying to touch on two key points. One, on the top of the chart, you can see non-cash trends are driving transaction volumes well above PCE, which is actually slated to grow around 10 to 11% for the next few years. But really, when you distill down the key secular themes driving this, one would be card not present growth, or e-com, and two would be integrated payments, which we'll get into both. On the bottom chart, you can see this from a different angle as both these trends are really more so augmenting higher card penetration, which is the dark blue bar on the bottom chart here, which is seeing pretty steady expansion in overall mix across most of the regions. And you can kind of see that when you assess it from a left to right basis. So moving to the first growth engine here on slide 36, card not present trends. So here the picture really tells the story where at the point of sale, consumer preferences have really seen an immense shift from brick and mortar transactions to more digitalized methods of payments. This includes everything from electronic wallets, which Scott alluded to pinless bill pay as well. So for a lot of my companies under coverage, all-in segment growth remains very strong here, with anywhere from high teen to low 20% processing growth in this segment alone. So that really brings us to the second leg of growth on slide 37. Pretty distinct trend across the majority of my payment coverage is really formed around integrated payment solutions. So first things first, what is it? This is really just the confluence of software that really stitch together multiple lines of business. So think everything from payments to general ledgers, expense management to HR roles. So this is really all housed under one integrated solution here. This is really search for a vehicle of growth for companies to tap into not only higher volumes, but better economics as well. This is really done by one of two ways. One would be either the merchant acquirer partnering with integrated software vendors, or also referred to as ISVs, to develop the applications in the specific industry that they want, or two, for merchants to fully build or outright acquire the solution in the industry that they want. You can see here from the slide, the TAM of this market is actually pretty large. Total gross processing volume of around anywhere from 1.5 to 1.6 trillion. And that's with healthy growth in overall revenue capture, which is more so articulated in the pie chart and the clockwise numbering schemes with different stats as you look and assess the whole slide here. So putting this all together on slide 38, all these trends have been immensely helpful for merchant acquirers. You have a few different breeds of acquirers that I list below on the slide, but here, obviously we're honing in on some of the integrated pure plays. But you do have some big conglomerate banks that dip their toe in the water. On the top chart, you can kind of see how this shakes out in terms of transactions. So WorldPay is the largest in the arena, which overtook First Data, I think it was in 2017, for the top slot with 25 billion in total transactions. You can also see this on the total bank card volume basis on the y-axis of the chart, and the total purchase volume on the x-axis. So slide 39 with economics. As Chris went into the actual MDR example, which is roughly $3 on a $100 transaction, I'm highlighting where potential economics could go with value-added services. So from the bottom left and kind of building to the upper right here, you can see the total MDR for both lower and higher volumes, and then kind of scaling in some value services, which are highlighted in the light orange boxes. You can see the potential effects, which would greatly enhance profitability going forward. So an upshot case, which doesn't happen every time, but could turn that 2.5 to 3% MDR into 4 to 6% with integrated services. So this has really more so helped fuel stronger revenue per transaction across a lot of these companies. For example, your TSYS and WorldPays have seen anywhere from low to mid-single digit growth in RPT alone. So with slide 40 here, it brings us back to back-end processors. So two key takeaways I'm trying to drive home. One, the total market beyond the point-of-sale payment terminals is very large at over 60 billion transactions yearly. This includes everything from B2B or business-to-business, peer-to-peer, cross-border network, deposit accounts, and overall money movement. Secondly, because of the emerging transactions, IT spend for banks trying to stitch some of these together as solutions for customers is actually on the rise. And you can see that with the blue bars here on the chart from left to right, which is growing at anywhere from a 4 to 4.5% clip. So it's interesting because this is despite the continued lull that you've actually seen in de novo applications or new bank filings, which is highlighted in the orange-blue bars below. So again, it's more of a shift from feet on the street banking to digital methods. So now here, moving to slide 41. Ultimately, we think this uptick in demand really stems from banks. And that's these banks needing to reduce friction across some of the outdated infrastructure that's actually been in place for the past 10 to 20 years. So back-end processors, they do play a crucial role helping break down the conversion for clients into more so digestible bite-sized bundles, which can range from the facilitation of transactions in real time to big data with loan approval analytics. So in the diagram here, you can see the potential offerings that are now hung off of core deposit accounts for money and payment transfers. So moving to slide 42, trying to put some numbers with this, total third-party bank spending continues to chug along at about 8% CAGR, and no surprise, payments remains a standout with 10 to 11% growth. But a specific driver here is highlighted below on the bottom chart, which is peer-to-peer payments. So contrary to popular belief, many automatically assume that non-bank peers lead the space here, like Venmo, but roughly 70 to 75% of all peer-to-peer payments are actually provided institutionally from clients as they look to, I would say, turnkey solutions like Zelle or Pop Money. But total growth actually reflects this. You've seen about a 20-25% CAGR, and it likely sees higher adoption as it becomes more of a viable method or alternative for households to pay bills. So here on slide 43 with some specific stock callouts. So first up on the left-hand side would be First Data. Everybody's scared of the debt here. FTC has no maturities until 2022, probably sees leverage, total debt to EBITDA, come down to about 4 times by 2019, and that's really powered by some strong free cash flow generation of around $2 billion a year. Really unparalleled scale when you think about it, with a strong reach worldwide. And it kind of gives you that steady eddy 4 to 5% organic growth on a yearly basis. So secondly would be Total System Services. It's a company with a well-balanced portfolio, and what's unique about these guys, they benefit from both the front end and some of the back end opportunities I just discussed, which we think actually drives predictable revenues and margin preservation going forward. And it's one of the few firms that we don't really believe needs to perpetually acquire and tuck in acquisitions to drive pretty strong organic growth, which is chugging along at about 6 to 7% right now. So WorldPay, as expressed in prior slides, leading merchant acquirer. Previous entity was actually known as Vantiv before their merger with WorldPay. But we think both the revenue and cost synergies built into 2019, probably second half, from that actual merger, and it's driven by some of that newfound reach overseas into Europe, which was purely domestic prior to the merger. So on the right-hand chart, we have some of these back-end processors more levered towards big spend, which remains on the rise, alluded to in previous slides. But this also pulls along some very indelible traits, in our opinion. So the high-quality FI clients have anywhere from 8 to 10-year contract durations, high contract renewals of anywhere from 90 to 95%. And that doesn't necessarily generate the same attractive growth profiles as a lot of the front-end processors, but it does really give you somewhat of a resilient revenue and margin profile. So most of these companies probably have a breakout of anywhere from 80 to 90% recurring revenues, and we think this actually comes into play. Given a lot of these companies have multiple levers to scale back intensity, given they've already built out a lot of the infrastructure, to drive more normalized free cash flow and earnings if the current stock market conditions continue to see some of these spurts of volatility. So with that, I'll pass this back to Scott for some Q&A.
Thanks a lot, David. So I hope you get a good sense of, CFRA's capabilities and thoughts as it pertains to the payments area. I hesitate to say this, but if you have a question and you want to ask it, you can do so through the GoToWebinar questions panel. We've gotten a number of questions at this point, but we could try to fit in something that is really great. So with that, let me go through some of the questions that we've received already. Two of them are kind of connected in that they are related to, let's call it overseas European regulation. So David, this first question is for you, and maybe Chris, if you want to follow up. By the way, the questions I'm going to paraphrase is, what is your take on overseas regulation as it pertains to Europe for payment processors? And then, Chris, there was a separate question around interchange fees specific to Europe and how they're regulated at a much lower level than in the U.S., and if there's a possibility that you could see the U.S. Regulating this area. So David first on regulation, and then Chris second on interchange fees, both overseas with a focus on Europe.
Hey, thanks, Scott. Interesting question. So I think there's definitely puts and takes there. We think that PSD2, or the Payment Services Directive 2, is actually a real opportunity to take advantage of for a lot of these acquirers. It's definitely a net positive. It definitely, I would say, opens up the funnel of overseas business, which is largely being gated off by large banking incumbents, especially in Europe. It could prove a catalyst for a lot of the properly positioned companies to take some share. But on the other hand, when you look at it, PCR, or Payment Systems Regulator, that directive could pose some risks if it's concluded that some of the processing fees that are currently in place are too steep. But for the time being, I would say that the progress continues to go as planned, with not very many hiccups.
Okay, great. Chris?
Yeah, so in the U.S. currently, debit card fees, like the interchange fee for debit cards, is partially regulated by the Durbin Amendment. So some of those debit cards are capped, those fees. But for the U.S., the credit card interchange fees are not capped at all. So that's why you have such high rates of anywhere to 2 to 3%, versus in Europe, they cap the credit card interchange fees as well. And these can be very, very low, like 0.4%, around there, or a little bit higher. We don't think that the U.S. will do that, although it's certainly possible. It could be a common reaction to say, let's cap these fees. It looks like the profits are very high. But the difference we've seen with Europe is they don't have near the rewards programs that the U.S. has. So even though these, going back to like the Chase example, even though Chase makes a very hefty interchange fee, they're not making money overall by the time you factor in those rewards expenses in the first couple of years at least. So whether it happens or not, you're going to see something else make up for it. It's not a free lunch, and so the incidence where it falls on whether it's the consumer getting less benefit or the merchant paying more, that can change, but overall you're not really going to change the economics of it.
Great, thanks. So a couple of questions have come in that I think are for me. One is around Square and whether it can rebound to its high. I I believe Square was recently, and when I say recently, I think probably in September, a stock trading at over $100. Definitely in that kind of like fall, late summer, early fall period. The stock now is in the 60s. Our target, our 12-month target price is also in the 60s. So I'm going to punt on answering the question directly because the short answer is I don't really know if or when that will happen. I can tell you, however, that we upgraded the stock after this substantial decline to a large extent. We actually, for a while, had a sell opinion on the stock, upgraded to a hold last month, and that reflected the substantial decline we saw. I highlighted a number of the risks that we saw and see around Square. Larger merchants really warranting, more attention to price, more attention to customer service, potentially pressuring overall, I'd say, margins, which is really important. Another question came in. How long is it going to take for mobile to replace cards as the main medium of digital/electronic payments? I think that's a good question. I don't have a specific answer for you, but it's something I get asked about a fair amount. And really the question often is couched as, at what point are you going to see, companies like PayPal and Square really functioning as stored value offerings that don't use credit cards or credit card networks? I think it's going to take longer than people expect. I think Chris pointed to something that's very important, which is the benefits that the card companies offer. I think there is a lot of investment in infrastructure around credit cards and related payments. We have seen the Cash App and Venmo taking payment share, and I think it's going to take some time before people kind of move from the P2P construct for those offerings to, more of a B2C, where people are paying for goods and services. So you're not only paying for products you buy online, but maybe you're paying your bills with Venmo and the Cash App. But I think it's going to take a pretty long time. I think there was an article in the Journal within the past week speaking to this very notion, which is everyone sees the world moving very quickly, but at the center are really Visa and Mastercard and their payments networks. I think we have time to squeeze in maybe one more, which I thought was kind of an interesting question, which is around the notion of, actually this one just came in, the merchant acquirers, David, why don't they get disintermediated over time is what one of our audience member asked, and that'll be our final question.
So I think it really comes down to, at the core, it's the strategy that they approach some of the consumer complexities with. Really, the biggest thing that they're really trying to do is reduce customer pain points. But at the moment, you've kind of seen a lean towards more of a partnership model, as I referred to with ISVs. But directly, I think it's interesting that both the ISV or partnership approach and the software approach, they both have opposite risks. So I think it's the biggest fear on the partnership side is the inability to more so scale individual channels into their partners. While with software, it's more predicated on not overbuilding their own IT stack to the point where you risk of becoming too top heavy and you can't execute, and you're too large and you can't service your clients. So with those two, I think it gives multiple avenues for some of these companies to maybe combat any kind of incoming pressure. So I really don't see that in the interim because of the scale issue that a lot of your other proponents might have. A lot of these merchant acquirers have established partnerships, established software for any incoming competitors.
Great. So on behalf of CFRA, I would like to thank you for joining us today. Thank you to both Chris and David for serving on this panel for our webinar, and thank you to our clients and end users for participating in today's event. The links to the recording and slides for today's session will be provided later today. In the meantime, I encourage you to check out CFRA's MarketScope Advisor for our latest research and our website. You can find it at www.cfraresearch.com to learn more about new research and upcoming events. If you ever have any questions for us, please don't hesitate to email cservices@cfraresearch.com. Thanks a lot and have a great day.